So we have an excellent opener for this second session. Pablo Casaux is the Sherpa for the Asia Pacific Financial Forum, the chair of the Sustainable Finance Development Network, and he'll explain more about what these are if they're not familiar to you within the context of APEC. He also manages to find somehow time to work for Bloomberg. He's going to tell us about the SFDN's important work for the Asia Pacific Economic Cooperation, the APEC group, including developing a sustainable finance roadmap. So Pablo, over to you, please.
Thank you, Peter. Thank you, Peter, Mike, for inviting me today. Congratulations on this open session so far. It's a very exciting event. So I really appreciate you inviting me to speak today. Let me, considering that our audience is global, I may want to start by providing some general context about APEC. Maybe not everybody is familiar with that. So if we can move to the next slide, just to provide some background to those who are not familiar with the APEC. This is a regional economic forum. It was created over 30 years ago with members of both sides of the Pacific Ocean. It's currently chaired by New Zealand. Thailand will be taking over the presidency next year. And recently, the US Vice President Kamala Harris announced a few weeks ago that the US is offering to chair APEC 2023. We expect a formal announcement by November, as it requires full endorsement of all 21 economies, and they're working on that right now. If we move into the next slide, the financial and economic topics in APEC are discussed by finance ministers and senior financial officials through what is known as the Finance Ministers Process, or FMP. This is a forum where the multilateral development banks, the OECD, IMF, together with the private sector, which is represented by APEC, the APEC Business Advisory Council, work very closely with finance ministers. Back in 2013, the APEC finance ministers launched 3 policy initiatives for public-private collaboration, the ones you see in yellow in the bottom, being the APFF, or the Asia Pacific Financial Forum, by far the largest and most active. The APFF was therefore created, and it's owned by the APEC finance ministers, but it's managed, the management was delegated to the private sector through APEC. Mike, if we can jump into 2 slides forward, into slide 5, we'll get back into this one. During the presidency in 2019, Chile introduced ESG into the agenda of the FMP. And in 2020, APEC developed an ESG workstream, which organized a series of virtual workshops throughout the year with the purpose of submitting finance ministers with a series of high-level ESG recommendations. These recommendations were welcomed by finance ministers in their annual dialogue with APEC, which included the proposal to develop a governance structure under the APFF to support the development of sustainable finance in the APEC region. This is the genesis of the SFDN, or Sustainable Finance Development Network, that I have the honor to lead. Mike, if we can go back then to slide 4 now. Like in the G20, the priorities for APEC are set by the chair economy. So we are currently in the scheduling a call with Thailand's Ministry of Foreign Affairs that will chair APEC next year, as I mentioned, to coordinate the network support and define priorities around sustainable finance. Having said that, the network has a general key mandate to address fragmentation in sustainable finance, both at policy level, as well as in terms of the fragmentation of initiatives and stakeholders, by simultaneously providing a platform to support them and a work framework to align them and build efficiencies in the process. Also, a key mandate for the network is to act as a forum to consolidate and raise the voice of APEC economies in global forums so that their context, nuances, interests are taken into consideration. This is the case, for instance, with IFRS, setting up a baseline ESG disclosure standard. Finally, the work will address sustainable finance from a holistic perspective, but will pay special attention to APEC's developing economies, SMEs, and to transition finance in terms of the inclusion of these realities in policy making, standards and framework, but also providing a platform to support capacity building needs. Mike, we can go back to slide 5. So I recently spoke about the journey that led to the creation of the SFDN in 2020. This year, the network launched its first 3 work streams, which are in line with what we probably agree are the most, some of the most urgent priorities. So these work streams are ESG, well, initially climate disclosure, taxonomies, and carbon markets. In addition to these work streams that I will discuss further in a minute, we have engaged in 2021 in socializing the network with key organizations such as IOSCO, NGFS, IFRS, ISO, and others, and in starting to develop the governance of the network with an initial informal working group and a secretariat, which is provided by the Financial Centers for Sustainability with full support of the UNDP team that is also acting as secretariat for the G20 Sustainable Finance Working Group, which, as you are probably aware, is also submitting a roadmap this year. The network actually participated in the private sector workshop organized by the G20 Sustainable Finance Working Group to support the development of this roadmap. The main deliverable for the SFDN for this year was included in our progress report to APEC finance ministers, and consisted of the first iteration of our own sustainable finance development roadmap that I understand that was shared with you and that we have also mapped with the G20. And although it has a broader scope and maybe a more pragmatic approach to the one at the roadmap at G20, it is well aligned and it has no contradicting points at all. So the SFDN roadmap includes a section that looks at sustainable finance from a holistic perspective, sustainable finance development from a holistic perspective, and divides it into 4 focus areas under which we list a series of building blocks with their corresponding action items. The main purpose of these building blocks is to provide a work framework for alignment of stakeholders and initiatives, as the network provides these with a platform to support them. In a sense, this is a similar approach to what the SDGs accomplished in a broader sustainability agenda in terms of alignment. But in this case, we are focusing on developing sustainable finance. So these are the next steps on this front. First, the Secretariat will engage probably in the first quarter next year with key organizations and with the economic blocs such as G20, ASEAN, OECD, to develop a consensus on a final list of building blocks under which to align the various action items. Then, as a second step, the network will reach out to key organizations with a valid proposition to address a challenge that is common to all stakeholders and initiatives, and you're probably familiar with. I think we all agree that in such a crowded space and with so much content being continuously created, anyone who wants to keep up with the continuous flow of papers, conferences, guidelines, roadmaps, recommendations, and other deliverables is facing a challenging task. And on the other side, those that generate valuable content and or actions usually struggle to get visibility by the whole ecosystem, and may be concerned that at any time a group of stakeholders working on the same topics get together to collaborate, and they're not included in this effort. So to address these 2 challenges, and to support visibility of our network stakeholders, the network is planning to develop a collaboration tool. So this is an information hub that will be using the roadmap building blocks once we reach out to consensus as a work framework. And we'll have a series of tools to provide the appropriate visibility and discoverability to our stakeholders material. We will be focusing initially on key organizations only for, I would say, administrative reasons. When onboarding these organizations, these key organizations into the network, we will invite them to contribute to this tool using the building blocks and some other tags to categorize the information for easy discovery. So in this process, we will also be organically developing a stock-taking exercise to map who is working on what, which will be extremely useful as the network starts developing new work streams under the various building blocks throughout 2022. Finally, let me share what our three initial work streams are currently involved in. So the first is the ESG, currently climate disclosure workstream, and this has two pillars. The first is the promotion of the Japanese TCFD consortium model as an effective and efficient governance structure to support capacity building and implementation of TCFD recommendations. We propose, since ESG is going to be focused, AFRS work on ESG disclosure is going to be focused on climate disclosure initially, we find this as a good starting point. So we proposed and helped the development of a pilot Mexican TCFD consortium, which will be launched in a few weeks, that we hope will provide a proof of concept for other economies to consider. Thailand, the Philippines, Indonesia have shown interest in this model. The second pillar around ESG climate disclosure has actually three phases. So the first is to provide a forum to develop input from APEC economies, and in particular developing economies, to the AFRS International Sustainable Standards Board being created, and its working groups that will be developing a baseline climate disclosure framework. The second step is to support the APEC economies developing their own frameworks, guidelines, regulations, promoting that both the local context, nuances, and needs are considered, but keeping some alignment with what the IFRS is developing to allow comparability and avoiding the need to have to unwind measures later on. And finally, the third step around ESG climate disclosure will be to support capacity building efforts by encouraging efficient and effective measures and governance structures, such as the TCFD model that I mentioned before, to support these efforts and to address the challenges that currently exist around disclosure, such as disclosure burden. The second work stream, the taxonomy work stream, is organizing a taxonomy symposium that will take place on October 27th in Asia, October 26th in the Americas, assembling those leading climate and green taxonomy in each of the 21 APEC economies. So the purpose of this taxonomy workstream is first to exchange information and approaches on taxonomy development and principles. The second is to provide an opportunity to establish contact and build a network among all these leading stakeholders developing taxonomies in each economy with their international counterparts working on taxonomy issues in order to enable further dialogue. And finally, the main takeaway is to facilitate the consideration of interoperability between taxonomies and related approaches in order to avoid fragmentation in climate finance. The main takeaway from this symposium would be to make a call to action to engage in approaches and coordination around the interoperability of taxonomies as they're being built, and will surely be followed by a series of workshops in 2022. As with any other work stream, we intend to avoid overlapping with existing initiatives, and on the contrary, to support them. That is what we're trying to accomplish. So in taxonomy, you might expect us to work closely with the APFF and others currently leading this agenda, and definitely involve the ISO taxonomy work in the process. Finally, we have been approached by the Chinese authorities, and in particular by the city of Uhren, that is designated as a registration center for the Chinese carbon market, to support in 2022 a series of international conferences on carbon markets. APEC is setting up a domestic committee in China to promote stronger governance support for the APFF in implementing the finance minister's initiatives. This committee organized this morning in Asia, last night in the Americas, an APFF 2021 China conference, where we organized, with the support of the Secretariat, a panel on carbon markets with the purpose to kickstart our work in this area and to start developing the topics for an agenda for the international conferences in 2022, as well as potential work streams that will be developed under the carbon market building block. If you can move into the next slide, Mike, for those who have not read the progress report and roadmap, this is sort of a preview of the focus areas, the ones on the left, and the building blocks that we will be seeking consensus on the right, as well as a sample of action items that we will have listed in this first iteration. We have listed in this first iteration of the roadmap under each building block. So this is basically the work framework that we want to develop for the collaboration tool, for aligning stakeholders and building work streams under each of them. And the idea is to provide this as a work framework similar to what the SDGs accomplished in aligning objectives. Again, this is a living document that will be have several iterations, and we will include new action items. The only thing that we will not be modified unless something relevant, very relevant comes up, is the list of the building blocks once we have reached the consensus. So finally, Mike, if we can move into slide 7. I hope this has provided a good initial outlook of the network. In the upcoming months, we will be reaching out to stakeholders to onboard them into the network, start providing support and alignment to their valuable efforts supporting the development of sustainable finance as a catalyzer to companies to transition to net zero and align to sustainable development goals. With that, ends my presentation, and once again, I thank Mike, Peter, for your invitation today.
Thank you, Pablo. That was spectacular, actually. Your command of covering this. I can think of no one else who could have given us such a succinct but also detailed explanation of the activities. And I personally think it's a really impressive work program you're embarking on. And I hope that all of us, as well as wearing our ISO hat, will also look to our own organizations as well to spread the word as to where we can communicate and help with you. Please, if you want to ask Pablo anything, this is your opportunity to put up your hand. I did want to just come back on one thing that you said, which made my ears prick up, which was that I think you're going to carry on through the APEC members looking at a stock taking exercise to see what is actually happening out there. I just wonder whether the output from that is something you would share with other organizations like us, because I think that sounds an enormously useful source of information, and I think we all, to be honest, struggle to keep on top of everything that is going on in this field. So if we can sort of collaborate on sharing that kind of information, that'd be helpful. But it's not available. I don't know. What's your thinking on that?
The answer is I don't know, because the baseline work has already been done by the UNDP as a secretary for the G20, and I do not know if that information can be public or not. We will be, what we're going to do is, as we start the induction process of key organizations, and by key organizations, and we're currently developing the list, is, you know, the usual suspects, so regulators, the IOSCO, NGFS, IFRS, key organizations, and thought leaders such as ISO. And in the process of onboarding them, we will invite these key organizations as soon as the collaboration tool uploading feature is already there, to start contributing information and their deliverables into this hub. And by tagging that information, we are automatically doing the stock taking in terms of what they're through their deliverables. You will see, so I cannot tell you whether that big information will become public or not, because it's outside of my responsibility. But what you will see is that this will result in the development of work streams, and the work stream members will be aligned I'd say we're populating these work streams according to their competencies and areas of coverage. So we will have probably a Sherpa for each of these building blocks. And I would say, let's say derivatives, usual aspect is that, for instance. But then we will have one or more work streams covering one or more action items within that, with specific Sherpas for each of them. That is the governance structure we're going to set up. It's going to take some time, and we will probably be focusing on priorities first. And of course, we need to develop the consensus on the list of building blocks. That's a prerequisite to actually move forward. But we want to be transparent in terms of what we're doing and who is collaborating, who is populating each of the work streams. So it will become relevant, will become evident, I'd say, when that comes up. If we are able to showcase this stock taking exercise, make it visible, definitely we will do. We want to make sure. I mean, our idea in terms of supporting work streams is to provide visibility to what they do. So and thus the collaboration tool. So that is something that will be part of our remit. Having said that, our focus initially will be on key organizations only. The ecosystem is so large that if we involve members and supporters, which are the other categories that we're considering, it will be, I would say, it will be unmanageable. But also the collaboration tool might end up being so crowded that even with search tools involving artificial intelligence, it will still be too crowded. So we need to sort out what information we place into that. And by the way, Peter, I forgot to mention, we're planning to make an official launch of the network at the COP26 in a conference on November 4 that the FC4S and the FIS are organizing to do some kind of real-time assessment of the decisions made on November 3rd.
Okay, no, that's very good to know. I hope to participate in that. I just got one question for just one more time for one more question. So it's actually asking, which really relates a bit to what you were just saying, that there's a huge workload here. Are you finding it possible to get enough people to come forward for these Sherpa roles, which gives sufficient sort of spread as well for the geography of APEC, or does it tend to be sort of dominated by one or two countries, or is there a mechanism to support resources to come forward? A question about resourcing, I guess.
Well, I guess in terms of the interest, even if we have not yet started to populate work streams or actually create work streams or officially launched the network, we've already had a very good feedback and interest and offering support from the Japanese authorities, from China. Well, Thailand is key because they're going to chair next year. So we have this pending meeting to define that. We anticipate a lot of support from the US. As we know, the administration is going to be very keen on our agenda. So in terms of, I would say, public support, we anticipate a lot of support. I don't know if they will become champions of the network or not, but in terms of operational support, they've already been collaborating. I mean, the Japanese authorities have been collaborating with the Mexican TCFD consortium very deeply. Now, in terms of populating the work streams, it's maybe too early to make that question because we haven't created that. Having said that, the SFDN falls within the APFF, the Asia Pacific Financial Forum, that has been working since 2013. And it has become a very effective forum for private-public collaboration. They have been very effective in bringing experts from all over the world for the different work streams that go well beyond sustainable finance. So for instance, we have another network, which is the Financial Infrastructure Development Network, that it's addressing issues like, you know, sharing of credit information for microfinance and SMEs, and we have an insurance work stream, and there are several work streams, and they have been very successful in populating. Now, sustainable finance is a whole new animal. There are so many people, and we're not going to restrict participation by APEC economy members because this is a global agenda. Again, our focus is to support APEC economies. But just by having UNDP supporting a secretariat and having one foot on G20 and APEC, it seamlessly will become a common agenda in several areas, especially in terms of aligning fragmented approaches.
Brilliant. I'm sure that'll be the case. I think it's tremendous. I'm sure we all wish you the greatest of success and luck with the progress of it. So thank you again, Pablo, for joining us today. If you're able to stay with us, that's great, but we really appreciate your contribution, and I'm sure all of the delegates found that really interesting. So thank you.
Thank you.
I'll move us on now. So our next session is to hear more from one of our external liaison organisations who focus on the social aspects that we were talking about earlier, coming very much to the fore in sustainable finance. So Jurgen Hammer is the Managing Director of the European branch of the Social Performance Task Force, and Amelia Greenberg is the Deputy Director and Director, I think, of the Responsible Inclusive Finance Facility for Africa and Middle East. And I think between them, they're going to take us through what they call the client protection pathway. So over to you, please.
Thanks, Peter, for the introduction, and thanks, I would say, to all of you, Peter, Mike, friends, for giving SPTF a chance to share an experience of a sector in that fantastic work that ISO is doing. What I would like to do before we dive into that example of client protection, just in a couple of words to give you a bit of a very quick introduction to what SPTF is and who we really represent. And if you can go to the next slide, please. Fundamentally, SPTF, Social Performance Task Force, is the industry network of the microfinance sector, working on harmonization and joint definition of what is social performance management. The microfinance sector clearly represents a very small niche in the financial markets. I sometimes like to call it a laboratory for many of the questions that are now concerning the larger sector and this entire discussion about sustainable finance. What is specific about our sector is that for 40 years, that sector has been working in a context of demonstrating how to achieve the initial promise of microfinance, which is achieving financial performance along with social performance. And what I would like to do quickly is to show how we did and what we did in that attempt to harmonize our language. We're a network organization, as I said, consisting of members from basically from the entire world, 125 countries. We are structured in a way that each of those stakeholders are in working groups. So we have the financial service providers, those who provide the service to the end customer. We have national networks and regional networks, a different group. We have a very active investor working group, coming, of course, with the interest of the investors, mainly European and US, but also Australia and some others. And the DFIs, and we increasingly work with the regulators through AFI, the Alliance for Financial Inclusion, so to really cover the entire spectrum of this industry. What we did, we had two options in order to develop a standard, a harmonized language of social performance in an industry. One option was to develop that at the higher level as an organization, and to basically promote it down and hope for implementation. And our approach was different. We said, let us get the stakeholders, those who have the practical experience, and that's a very important element. Let us get the practitioners around the table. Basically, what we are doing, we're addressing the table, and we help the practitioners among themselves define, develop, and then implement and promote standards and practices that put the customer in the center. So in terms of organization, as I said, it's really a bottom up, which is a fundamental element to reach an implementable and actionable methodology of standards and to get implementation. If you go to the next slides, and I will not go in detail into that, but you have a web page on the bottom of it that gives you the result. After we started in 2005, after 6-7 years of coordinating this entire sector, the sector came up with this definition, or with that structure of saying social responsibility can be grouped, structured in 6 major dimensions. The standards are 7, 6 are social, and the 7th is just now finalized and launched green. The social dimension covering strategy, covering governance, covering clients, client protection, covering staff, covering products. So it's one way, it's an agreement of our sector to structure what is social responsible management and what is social performance in the provision of a financial service. And I do invite you to have a look at this web link. I can put it in the chat box also. That gives you more of a detail, and we will dive a bit into the dimension 4, which is the client protection dimension, which Amelia which we will share later with Amelia. One more slide about how we work, and that is an important element. It's not just about developing a standard and measuring. The entire setup of the organization is really a pathway for improvement. We structure that in learning, understanding. I mean, we are confronted to that. There are so many terminologies that are thrown around. And it's difficult to understand what we are talking, and that's really the first level, learn. The second aspect, but it's just one aspect, is to assess. And based on the assessment, we can plan improvement, see where there are lacks towards best practices and good social performance management. Implementation of those learnings, and the last level of that is the reporting. So it's really a pathway through social and environmental performance management. Maybe I pass to Amelia for the next slide to show a bit more how that fits into the ISO work.
Hi, so yes, please, next slide. It's very nice to be here to meet all of you. This is the first time for me joining an ISO working session, and I'm delighted to be here. So thank you for the invitation. What I'm showing you on this slide and the next are some of the work that we did when we saw the ISO principles for sustainable finance. We had an opportunity to comment. What we realized, one, is that these messages are aligned with our own learning from our almost 5,000 members over the past couple decades of what is important to be thinking about when you're managing your own practices toward sustainable finance. So that was great to see the alignment, but we also thought this group might benefit from knowing that in our standards, we include not just sort of the higher level principles and ideas, but also these concrete management practices. So when an organization assesses its own performance, it has a really specific idea of what it is we are saying they should be doing. There's 2 slides because actually our manual is organized and the standard level is a big general statement about what should be happening. And then within each standard, there are what we call essential practices, or EPs, which are still fairly general statements about the management practices to be implemented. And then there's an additional lower layer, which we'll see on the next slide, which are the indicators, the actual assessment indicators you would use to understand whether you're in compliance with these standards. And so those are the ones that we thought might be useful to the ISO community as you're thinking about how to implement and make really actionable the principles that you have for sustainable finance. So just as an example, one of the ISO principles is governance and culture, and it has 3 big concepts within that. One is that about boards setting a strategy and having that strategy be based on this list of things that the board should identify: value, liability, impact, risk mitigants. So then you use that information, the board builds a strategy. The second big concept in there is that is more on the oversight. The board should satisfy themselves that the organization is adequately addressing risk, creating value, and inspiring stakeholder confidence. And then the third big concept in that principle is that senior executives also should be committed to the organization's sustainable business strategy and be accountable to stakeholders. So those are big sort of concepts. And if I map them to the universal standards, and again, the point of this is showing how if you want to go out and tell people how in practice do I implement what you're talking about. Well, our dimension 2 is called committed leadership. And the first standard in that has to do with the board. And it says members of the board of directors hold management accountable for achieving the provider social goals. And by provider, we mean financial services provider. So this is really aligned with what we see in the ISO principle of boards are having the strategy and then monitoring whether the organization is achieving the strategy. And when you look at our essential practices, we do already get into a little bit more detail. So the board composition reflects the provider social strategy, and there, when you get in the indicators, you'll see what we mean. The provider trains its board members on their social performance management responsibilities. The board makes strategic decisions based on social and financial data. The board oversight of senior management is in line with social goals, and the board is responsible for preserving the commitment to social goals even during times of crisis or institutional change, like we see a lot of different financial institutions changing their legal structure. And if you go to the next slide, this is where unfortunately, the font gets really tiny, but also you can get an example of what we're talking about. So just one of those EPs, the board makes strategic decisions based on social and financial data. You can see these indicators where the first one says the board uses the following data to monitor client protection. And then there's specific data, analysis of the risk of client over-indebtedness, analysis of different types of data about client dissatisfaction, which are rates of dormancy, rates of dropout, information you get from exit surveys, and client complaints. The board should also be looking at interest rates and whether those levels are responsible. They should look on reports on the provider system for data privacy and security, particularly any failures or breaches, data on negative outcomes that clients have experienced from using financial products, and reports from any fraud or corruption investigations. And then the second indicator said, so those first one are all about client protection, which is really about do no harm, the type of data that you look at. And then the second one is looking at data that's consistent with your social strategy. So what good are you trying to do? And so our details are the board should be looking at data on outcomes related to social goals, social audit information, how the provider is allocating profits, and whether the use of profits is aligned with the social strategy. And then we have another indicator that says, you need to use data to monitor decent work conditions with your own employees. So you need to be looking at employee turnover rate, segmented by gender, and analysis from employee satisfaction surveys. And at the last one, the board takes corrective action when social targets are not being met or when risks are identified. So if you go back to, can you go up one slide again, just to say, this is sort of the meat. When you transfer from the principles through our document, I think at all levels, not just the principle on governance and culture, but you will see that this resource that we've published, and again, it's not SPTF writing it, it's based on the experience of our members in the field and in the financial inclusion sector, which started with microfinance, but now includes a wide range of types of financial service providers. So we have these more concrete management practices defined that if you wanted to say, okay, I want to be compliant with the ISO principles on governance and culture, what specifically does that look like in my organization? It might help you to read the standards manual and be informed by the practices that you see there. And even here, my last point is this third bullet about how senior executives also have a role to play for ensuring sustainable finance. That's our entire second standard. So standard 2A here is the one about the board of directors with all its EPs and associated indicators. And then when you get to standard 2B, there's a similar level of detail about what you would expect senior management to do. So you can go ahead, advance 2 slides, and I'll turn it back to Jurgen. But if you would like more information about the universal standards and the other management practices we have in there, please don't hesitate to contact me.
Yeah, thanks, Amelia. I'd love to dive now into another concrete example, client protection. It's Client protection in financial services, sorry to be that blunt, but it's basically a non-brainer. We need to make sure that our clients are protected. What we learned in 15 years of working with client protection principles is that just having a standard that organizations endorse or adhere to is not enough. We need to have concrete implementation. So we have reworked, built on all that experience, a client protection pathway, which values the progress an organization makes towards best practices of client protection. This pathway has 3 steps. The first one is a commitment. It starts with a commitment, but a commitment that comes with transparency, basically with disclosure of what an organization is achieving. The second step, and that's the big value added from us as a network, is based on that first level of assessment, identify weaknesses and improve practices. That's vital. And we have seen, and you know many of those, we have seen many examples of non-functioning client protection in microfinance. There's a huge reputational risk to it because those are the issues that the media are focusing on. And many of those organizations adhered to principles, but they were not implemented. So that's a huge step. All of this is open source. Organizations can see where their weaknesses are, improve. And the last step is the external evaluation. And if you go to the next slide, just to say we have a system of external evaluation. We call it certifications in 3 levels, which make sure that, and it's very detailed. It was a year of work with the market to identify what is absolutely necessary, what different sections of entry-level indicators, we call them. But just to say, there are external evaluations which help investors to show the progress that they have been making. The next 2 slides, and I would say in the interest of time, I will just invite you to have a look at that. The presentations are available. It's giving a couple of benefits for the financial service providers. I think it's clear to many of us what are the benefits of harmonized language in social and environmental performance. And we also have a slide that's the next one about what are the benefits for the investors, finding committed organizations, addressing technical assistance specifically to those identified needs, and having a reference, a standard that investors can use in loan documentations, in loan contracts, in eligibility, etc. We have put here a page of investors that are committed, and many DFIs and investors implement that kind of work today with their investees to make sure that client protection is implemented and is effectively applied. And we have 2 more slides, and then we're open to questions, and I'll put it back to Amelia.
Yeah, so the last 2 again can be brief, but just to give this group a taste of what else we're working on in case it's relevant to what you're working on and you'd like to collaborate. So one is that we are in the process now of identifying management standards that are specific to responsible digital financial services. So many financial institutions in the broad financial inclusion sector are incorporating digital elements. And there are also new types of players, not so new anymore, I guess, but relative to traditional banking, different other kinds of financial service providers are purely digital and providing financial services to clients, including bottom of the pyramid clients. And so it's important to understand what responsible practices look like in that context as well, both so investors can direct their funds toward providers who are being responsible, and so the providers that wish to be responsible can proactively see these standards and adopt them before they harm clients. And we do already see huge client protection risks and problems in some markets with some providers. And so we hope to be a solution for that. But very quickly, we've done some, this is a very crowded, again, space in terms of a lot of people identifying the risks they're seeing, some excellent research, a lot of high-level principles coming out, but no one yet going down to that concrete level of management, actual specific management practices that a financial institution would implement. So we are starting with what's already been done before us. We're doing a bunch of expert interviews right now. We're going to have a working group launching next year, and anyone would be invited to join that working group, where we would just go sort of dimension by dimension in terms of the different areas of client protection risk that we're seeing, and potential for digital help us to serve clients better, and work on some standards. So you can go, I guess I have a few examples here. So one of the problems that we're seeing, for example, is poor client complaints resolution when financial service providers work with partners. If they are partnering with mobile network operators is a very common one, for example, and something goes wrong, we're seeing a lot of problems with someone calling the financial service provider and they're saying, well, a network outage issue is the mobile network operator's problem. And then they call them mobile network operator and they say, well, you're a client of the financial institution, talk to them. So that's one of the problems where we're trying to work through. Another major problem we're seeing is exclusion of certain populations, even though digital financial services are supposed to be allowing for greater outreach and greater inclusion. We're seeing people who are not literate, people who have in unreliable internet access, people who don't always have a phone or must share their phone, in some ways are getting more excluded now than they used to be. So that's what we call the digital divide. You can go to the next slide. The other area that we're working on that might be interesting to you is outcomes measurement and management. So this has several different axes. One is if you don't have any client outcomes data, but you still want to understand if your products and services are benefiting clients, can you get information from the data that you already have, which is just the socioeconomic and demographic kind of client profile data, plus their financial transaction history? Can doing more targeted analysis of those databases give you some insights into who's using what types of products to what effect? Also trying to think of, if people are going to collect, financial service providers are going to collect outcomes data, what questions should they be asking? What's really actionable and useful in terms of helping them make strategic decisions and business decisions that help them be more sustainable? We also talk to everybody else who's working on outcomes to try to stay aligned. And so this is another area where we have an active working group. And if you're interested in participating in the conversation, we'd welcome you to join. And with that, I will stop.
Thanks.
Thank you very much, Jurgen and Amelia. That's really, really helpful. And I'm absolutely sure that there's some crossovers there, and note your working group starting up next year. But I think you picked two very good examples at the end there in terms of digital. That is definitely an area of interest, and we've just forming a technical group, as I say, on fintech. So there's an overlap there. And also what you were saying there at the end is similarly, I think, very relevant. So very apposite. I see Jurgen's also put the link in there, so I'd encourage delegates to use that as an entry point. We're progressing quite fast at times. We haven't got very long for questions. We're just pausing to have a look here. The only one I'm seeing there, which I'll just pick up, is in terms of the work that you're doing across the piece on the SPTF. Do you see any differences between the needs of really big organisations and small organisations, or do you actually think you can boil all those down to a common standard, common process?
Yeah, I would say the general principles apply no matter what your size. So in terms of being very deliberate about your strategy, having a committed board, having a committed management, but what that looks like in practice is going to be very different if you're big or small. So, we know bigger organizations can have whole research divisions. We know that the bigger you are, the more sophisticated sort of budget and access to technology that you can have. But some of the core principles really about listening to your clients, designing products and services that meet their needs. There are low tech, low budget ways to do that, even if you're a little cooperative. So that's what I would say is we do intend the principles to be applicable to all, but that's why we don't get very specific in how you're supposed to do it. So we say, you know, verify the security of your data. That's going to look very different if you have 1 million customers and a huge number of servers versus if you have, you know, one location. So that's what I would say.
Brilliant. Yes, concentrate on the what, and then the how is more a function of the organization.
Of the size of the organization, exactly.
Fantastic, fantastic. Well, look, in the interest of time, I'll have to move us on, but thank you again very much. Obviously, very pleased to have your ongoing input, and I hope that we'll also be able to put resources in your direction to support your own program, because they're very, very compatible, as you say. It's a very good overlap, I think, in our purpose. So thank you again to Jurgen and Amelia. So next, I'm pleased to introduce one of our most active experts in international sustainable finance, Kim Schumacher of the Tokyo Institute of Technology. So he's up late, is presenting us on the importance of science-informed sustainability reporting in fighting greenwashing, which we know is one of the key objectives of producing standards in this area. So Kim, over to you.
Thank you, Peter. And I would also give a shout out to my Japanese colleagues who are also up this late. I see a few of them among the participants. So just to we're all in the same boat time-wise. But as you said very correctly, so and this is sort of like a mix what I bring to the table in terms of ISO, but also in terms of my own researches and my own activities in this space. And so next slide, just to provide you with a short overview. I'm not seeing anything at this stage. Okay, so as a personal introduction, I think maybe in terms of view, just go single page view might be. I'm just still waiting for maybe.
Yeah, I'm just trying to get the.
No worries, no worries.
Hopefully we'll, and then we'll have to speed through. So I know you have quite a few slides.
just zoom out a little bit. Maybe that might be.
I think he'll come back on when he's got it straight. I'm not quite sure what's happened here. Kim, just bear with us.
No worries, no worries. and don't worry. I think some of the slides are really just like eye candy. So we'll get to those quite speedily. Okay, I think here we go. So so just a personal introduction, then some fundamentals of sustainable finance, defining greenwashing, crucial role of data. But in the interest of time, let's just go to the next slide. So personal introduction, just to give you a context. So I'm an environmental scientist by training, but in a very long past before, I also studied environmental law. And I was a postdoctoral researcher at the School of Geography in Oxford. That's where I really came into touch with sustainable finance. And right now, I'm a senior research fellow and a lecturer at the Tokyo Institute of Technology in sustainable finance and ESG. That role will change soon. I cannot tell you more about that, but it definitely goes up. So more in sustainable finance than also soon in Japan. But next slide. So since 2017, I have been a technical working group member of the Climate Disclosure Standards Board, which I still am. Then also in the Climate Bonds Initiative, so fixed income. Then in the ISO, I'm the representative on the ISO TC322 for Luxembourg, originally where I'm from. Then I'm a member of the Global Sustainability Standards Board of the GRI ever since this year. And then also this year, I've been appointed the Science and Sustainability Advisor and the Chair of the Scientific Advisory Board of Spurkis, Luxembourg's largest bank. So very involved in all the different initiatives around like the financial sector. So next slide, please. And then just in terms of environmental management, also very active in a lot of stuff. So around the environment and earth systems. Next slide. So my research revolves around data, and that is especially where we get to the greenwashing part, where the juicy bits and where science becomes very relevant, because data has sort of become the new currency in everything, measuring performance in the sustainable finance and ESG space. And it sort of has become a currency of like, yeah, how do I say it, of reality, if you will, because like we all hear about fake news, we all hear about, and fake news is often used to undermine science. We saw with Corona, with COVID, there have been suddenly 8 billion different virologists in the world, all having their own opinion, but few actual experts whose voices were heard. So it shows that data is becoming a crucial element in terms of identifying and measuring performance around corporate performance, but also financial, how financial institutions perform. And without it, proper data, without data that has been properly measured, reported, or verified, we cannot have a sustainable finance or ESG investment sector. It's simply not possible. So my research revolves around that. Then next slide, please. And I write on sustainable finance. Currently, of course, I'm based out of Japan. So a lot of my research focuses on Japan as well. As this previous slide has shown, my research is currently funded in part by the Ministry of Environment on ESG data. So that is where my expertise lies. So next slide, please. And then here I was transformed into comic. So I'm the science and sustainability advisor for Luxembourg's largest bank. So that was one of the elements where a lot of banks currently still fail because they talk a lot, they talk a big game in terms of ESG and sustainable finance. I'm not saying that everything at Schwerkis Luxembourg's bank is everything is perfect, not by any stretch, but I would say it sometimes starts, we all talk about science-based, we all talk about sustainability, but one of the things where greenwashing comes into play is often there's very few actual experts in the room. There's people with titles that are similar to what ESG expertise would be, but when you actually look at the track records, that often there's very little bit sustainability inside with a sustainable exterior. So that is where that is something that needs to happen at the organizational level. So next slide, please. And then, we can just go over that. I already mentioned that I've been in this GRI Sustainability Standards Board ever since this year. Then next. So we all know about this year, very recently came the climate change 2021, the physical science basis. So the assessment report 6 by the IPCC. And as has been shown throughout the previous reports and special reports, the situation is dire and it's not necessarily improving for the better. The same with the Sustainable Development Goals. We are basically on track of failing to meet all of them. At least some were very close, but we have not reached any of them yet to its full potential. Then if we go to the next slide. And again, here it's temperatures are rising. We are now already to pre-pandemic levels of carbon emissions. So that is the established science. And with that, since there is a goal, that also means that the goal is hard to meet. And whenever that is the case, whenever that is the situation, then it also creates incentives to reduce emissions. But then, because with reducing carbon emissions, that also comes along with a lot of cuts in terms of, be it in terms of lifestyle, in terms of that is when greenwashing comes into enters the room, because then we want to show that we are doing something without actually having done anything, or with our efforts not necessarily being substantial. So if we go to the next slide. As I said here, carbon dioxide in the atmosphere hits records despite pandemic dips. So we are already above the pre-pandemic levels of CO2 emissions. So the pandemic just gave us a very brief, if any, relief at all. Next slide. And I'm sure some of you have seen this. We are, if you look at the biosphere integrity and if we look at the biochemical flows, that basically means biodiversity, and in terms of the integrity of the atmosphere, we are not on a good track. So we, in terms of carbon emissions, and this graph is famous, but it dates from 2015. So I'm sure some of these parameters have already worsened over time. So we are stretching the resources of the planet really to its extreme in certain areas and already beyond what it's capable to regenerate or replenish. And that is whenever, like, yeah, the science already documents that something needs to be done. And also every year, like, yeah, we see more extremes, especially in terms of wildfires, extreme heat events or extreme storm events, sea level rises. And so the science, and with the IPCC report that I previously referenced or mentioned, the science is pretty much already established in a sense that we acknowledge that there's anthropogenic climate change or global warming, and we also see that there will be consequences. We cannot really sometimes, let's say, like exactly to the exact meter where it will happen, but in general terms, we already know what could be the consequence, and often these consequences are materializing worse ways than models from 20 years ago predicted. So we are already seeing the worst case, some of the worst case scenarios that were predicted decades ago. So that is where the science is important, but that is also where we see that we talk a lot about science, but then at some point in the financial sector, and that is when I want to talk about, like, yeah, sustainable finance, is often science is very much absent in the decision-making processes. And that is where we can go to the next slide, which is just more, also the next slide, which is just more documentation that as, like, yeah, global wealth has been increasing, so has been, it went along with the decline of Earth systems. So the more wealthy we became, the less well did the Earth ecosystems, like, yeah, developed or, like, yeah, turned out. So there's a negative correlation between our well-being and Earth's health. If we go to the next slide. And we do depend on ecosystems. Our entire economic system is structured around the functioning of ecosystems. And if those collapse, then there can no be such thing as sustainable finance. There can no be such thing as finance. Or maybe it would be replaced by disaster finance, that we just, like, yeah, start trading in, like, yeah, who can deal the best with, like, yeah, whatever bad situation there is. Because we do, and with the pandemic, we have seen already how much, like, yeah, being stuck inside, how much we actually do miss sometimes, like, yeah, for example, the cultural values from nature. But in terms of provisioning medical resources, medicinal resources, fresh water, all those things, it's just clear that we rely on our functioning ecosystems. If we go to the next slide. And this is just another slide in terms of natural capital. So if you go to the next slide. So with all these risks, this is a slide from the Network for Greening the Financial System. There's physical risk drivers, sea level rise, storms, heat waves. Of course, they will impact the economy. And that also will impact the financial system and vice versa. If the financial system is at risk, or like the underlying structures to the financial system are at risk, that also means it will impact the economy again. So, and the same is for, if we go to the next slide, is with transition risk drivers. So the same happens. So transition risk drivers, physical risk drivers are, like, yeah, the physical impacts, and transition risk drivers are what we as humans, as societies, do try to respond to that. Either we governments implement climate policies, for example, carbon taxes, or like technology, renewable energy or electric vehicles, some of the notable ones, or consumer preferences, people moving away, for example, from meat towards, like, yeah, plant-based food in response to, like, yeah, some of the ethical but also environmental impacts that come with meat consumption. So those are all things that will also impact the economy and then again have impact on the financial system. If we go to the next slide. And in terms of investing, that has now shown, like, yeah, into a growing market, for example, where excluding certain elements like fossil fuels very recently, weapons, gambling, things like that, or ESG integration, considering the environment or considering social factors, for example, gender equality, or recently work conditions, very important, or the fight against corruption. These become now more prominent. And if we go to the next slide, it has just materialized in a financial system where sustainable finance label products have exploded in volume and also more and more in terms of like, yeah, just overall share in the financial sector. Recently, there was an announcement of the EU's green bond having like, yeah, broken several records in terms of size. So we see there's a lot of terms, sustainable and green. And but if we go to the next slide, defining greenwashing. So now we get to the part. So greenwashing is defined as the process of conveying a false impression or providing misleading information about how a company's products or services are more environmentally sound. And it's considered an unsubstantiated claim to deceive consumers into believing that a company's products or services are environmentally friendly. And if we go to the next slide, we also see now in sustainable finance space, there's like already light definitions. For example, the EU is defining it as the practice of marketing financial products as green or sustainable when in fact they do not meet basic environmental standards. And then if we go to the next slide, and that's where the ISO comes in. The ISO also in one of the, I will not go through the entire definition, but just to say, now we also try to like, indicate what is considered greenwashing, because it has become such a significant problem in the sustainable finance or green finance space that greenwashing now, just making claims that you can either not prove or where you have no data for, or where you do not have the capacities to even prove whether or not anything that you say is true or it is not verifiable. Everything like, especially optimistic claims, those are the ones that are now popping up everywhere, where it's being claimed that we have an impact on biodiversity, or it's a claim that we can reduce carbon emissions with our investments. And that is something that is very prominent. So we defined it, and that can actually be found in this most recent one. I think I made a mistake. It's 14100, not 1401. So guidance on environmental criteria for projects, assets, and activities. So if we go to the next slide. And now there's more and more news coming up where people say, yeah, ESG, there's a lot of talk, but the actual like, facts do not add up. If we go to the next one. So for example, some regulators are now looking at funds and they do not find enough evidence to back up the claims that are being made around these funds. And that is already a very worrisome trend. If we go to the next slide. Again, just more of it, like, green funds not living up to their promises. And then the next slide. So competition watchdogs and regulators are now becoming more aware of what greenwashing represents. So because the risk is that we feel like something is happening, but in actuality, nothing is happening because it just looks green on the outside. But since no one is measuring any impact, no one is reporting their impact, or the impact is not being verified, then we have no way of knowing if actual impact has occurred, or positive impact for that matter. So if we go to the next slide. So the data right now is mostly from self-assessed sources. It comes mostly from reports, corporate reports, or from business and general news, which again often are derived from annual reports or from company sources, industry level questionnaires and surveys. So the majority right now, apart from some publicly available statistics and NGO, NPO generated reports, almost all of our knowledge around corporate ESG performance or sustainability performance originates from the companies themselves. And often they are not properly assured or verified, especially the non-financial claims, like environmental claims, social claims. If we go to the next slide. Then they flow into databases, ESG databases that are then being used by financial institutions, because as I said in the beginning, often they do not have like sufficiently trained experts sitting there who could evaluate whether or not the ESG data is reliable or not. How many banks actually have a biodiversity expert sitting in their midst who could verify whether or not any of the data that they are using is reliable, or any data that has been reported by a company or throughout a supply chain is reliable, or a water expert, or an actual climate scientist? How many institutions actually have that, who could say like, oh, that data does not really look like, like it's correct? that is often one of the main problems in terms of establishing sustainable finance and making it verifiable. If we go to the next slide. Next slide. So it's a survey, and corporate ratings have become such an important part. And also, as we see, also corporate sustainability reports and direct engagement with companies. So basically, we get most of our information directly from the companies themselves without almost any external independent peer review. So we basically rely on the companies to tell us how they are doing. But since also few institutions have any actual external experts who could even verify what the company has reported adds up or not, that is one of the key problems. If we go to the next slide. And data has been rising quickly because most of, what I found in my research is what usually an ESG analyst or what most ESG experts expertise in financial institutions amounts to is an analyst who uses a Bloomberg terminal to look up ESG ratings. That is what usually ESG expertise most is these days. And it just shows with this explosion of the ESG data market, how much financial institutions rely on that, because it is not enough just to add the term ESG to an existing job title to make a person an actual expert. That is not enough. So that is why so many rely on external ESG data services. If we go to next slide. But now there's calls for public data, because there's this acknowledgement right now that data can simply not be intransparent. It's similar to what we see in the science world. There needs to be some form of transparency to even be able to verify any claims, especially non-financial claims, like environmental claims around climate data or biodiversity data. If there is not, and if you do not actually have the capacity to have experts look at any data, then how can you trust any of the data that is being given, especially if many of the organizations do not have large teams to collect non-financial data across their supply chains. And that is why now there's calls to create open databases where actually you can verify data and see if it adds up. Next slide. So, and it says what determines the rating quality? So these ratings that are currently being used, it's the credibility of the data source. So if the data is not solid, if it's not properly disclosed, not properly reported, if there's no proper standardization, the quality of the methodology. And also what we see more and more is the experience competence of the research team. So if you do not actual experts sit in those teams, in those ESG teams, in those sustainability teams, in those climate services teams, if it's just a person who has been given the title climate or ESG, but the track records do not indicate any solid knowledge in the more complex elements, and especially the scientific elements, technical elements, that is a reason for concern. And also it really chips at the credibility of the entire sustainable finance sector. If we go to the next slide. And I promise I will go through the next slides a bit more. We can ignore that one. It just shows the research teams are now becoming more and more important. And that has led to ESG ratings basically being what they are right now, and that means highly divergent. So if you go to the next slide. So here we see, for example, if you're an investor and you buy an ESG data service or an ESG ratings, and if you would go with one of them, for example, KLD, and you would buy Samsung Electronics or Google, with KLD, you would get a great ESG score, or with Samsung Electronics, a very bad ESG score. And if you buy any of the other ones that, at least in this list, it would be pretty decent, or it would be around quite neutral. So it just goes to show that the data right now, or the ratings are extremely inconsistent. And that paper has been much cited, but one of the key problems of the paper in and of itself is that the authors did not have access to the raw data. So they did not know what kind of data did the rating providers actually use to come up with their ratings. So that is also a huge black box right now. We do not know what underlying data they actually use. And if we go to the next slide, that is in part because in a lot of reports do not provide sufficient disclosure. A lot of companies either like, yeah, the detail is not enough, the methodologies are not clear. So we're still a far way off, especially in terms of non-financial data. If we go to the next slide, that is why these ratings, if not properly transparent, they can lead to greenwashing. And that is, for example, from the European Securities and Market Authority. So regulators also become aware of that. If we go to the next slide. And with the EU, I will not go too much into the taxonomy. It's just to show that regulators are now working on solutions of what can be considered green and what cannot be considered green. You can go quickly through those slides. It's just to show like, yeah, there's now rules of what is green because the ratings cannot really are not credible because the company data, the corporate data behind it often is not credible. So now we need to establish rules, benchmarks, thresholds in order to, at what point is an activity green and when is it not green, because otherwise there's no way. But that still means we need to know the actual reliable data. And that is where standardization becomes really important. That's why I'm involved in the ISO. If we go to the next slides, I just want to go, we can skip those slides.
Need to flick through now, I think.
Yeah, just go to the end, to the, I said enough about data. Also, we can go through those cases of greenwashing. There's a lot of greenwashing risks. You can go through those. Tesla is one of the examples. Boohoo in the UK was one. Tobacco, pharma, all net zero pledges, greenwashing, and then net zero also, like, yeah, not enough capex. A lot of companies announce a lot, but do not invest any money into like achieving those goals. We documented that in a paper around carbon washing. Next slide. So why science matters? Because in terms of materiality, and I just want to spend 2 minutes, if permitted, then I will go
last 2 minutes.
Into the detail. Yes, materiality is extremely important. And if we go to the next slide, next slide. So the double materiality concept is extremely important because it's not only financial materiality. Now it is also important to measure the impact that companies or investors have on the climate, on the environment. And how would you even implement it? How would you measure that if you do not have any solid scientific expertise in your midst? How is that even possible? Because if you have no environmental experts sitting there, how would you even know what your impact on the environment will be? And if we go to the next slides, I just want to go one final slide. I will, so also regulators say now, you need to have the skills and expertise, and just, I will say what slide, we can go through those slides. Also those had a lot of slides, also those, go through those. Sorry for everyone. Please contact me if you want the slides. Also further, I just want to have one slide, final slide. Yes, that one. That one is the one. Competence greenwashing. So that is an article that I wrote, which has gotten some traction. It's to say now, because the financial sector is also in a transition, and it has to, it has pressure to show that it's becoming more green, but it also, there's not enough experts currently working, environmental experts or climate experts working in the financial sector and advising it. So what a lot of financial institutions have been doing, they have been relabeling themselves into like, yeah, they have the ESG analysts became ESG, or their analysts became ESG analysts overnight, or some of their head of sustainability did a quick sustainability leadership course or an online ESG certificate and suddenly is claiming to be an ESG expert. That is a very large risk that also in terms of greenwashing is at the underlying thing, because if you have a fund, a sustainability fund that is managed by someone who has no whatsoever track record in sustainability, that leads to the results that we found more and more in terms of funds, sustainability claims being questioned by regulators. Thank you very much. Sorry for the going so much over time, but
Thank you, Kim. No, I mean, firstly, thank you for putting together that set, and to remind everyone that the slides will be shared, they'll be available. And so there's an opportunity actually to dig further into all the examples you gave. So it's a tremendous resource, which we appreciate. But it's also very good to hear. I'm reminded of the phrase that the expert in the room is the ignorant person who knows slightly more than everybody else. And I feel at the end there, that's a bit what you're telling us is happening in parts of finance at the moment. So, okay, in the interest of time, I will have to move us straight on to the next and,
no problem at all.
Final presentation, but thank you again, Kim. So last but not least, I want to welcome John Uhren. He's chair of the National Mirror Committee in Canada for TC322. Canada has become deeply involved in sustainable finance standardization work recently, and he's going to give us an informed view of sustainable finance activities and trends in Canada, which has its particular challenges, I would say, in terms of the transition pathway. John, hand over to you.
Excellent. Thank you, Peter, and to you and Mike, thanks for having me today. In my day job, I head up products and strategy on the sustainable finance team at Bank of Montreal. So to Kim's competence greenwashing point, I hope I just know slightly more about sustainable finance than the next person, but nevertheless, I've been doing the job for a couple of years. And I do think it's a really important time in Canada. You know, we just had an election less than a month ago where for the first time, all major parties had detailed climate change platforms, all committed to net zero carbon emissions by 2050, and all were in favor of serious carbon reductions by 2030. So I thought it made sense just to spend a couple of minutes, you know, detailing a little bit of the policy and regulation that we've seen from the Canadian government, and then outlining what we've seen and you know, more importantly, forward-looking what the opportunity is for both issuers and investors in the Canadian market. So on this first slide, you know, what you're seeing is just a bit of an overview of what we've seen to date as announced by the Canadian government. And namely, you know, they launched a Sustainable Finance Action Council earlier this year, which really brings together public and private sector players, you know, banks, insurance companies, pension funds. The intention of this council is really to drive the growth of a strong, well-functioning, sustainable finance market in Canada. It's open-ended. Certainly it'll be, you know, the outcomes will be aligned with the net zero by 2050 pledge of the government. But beyond that, it's really looking at all different levers across the equity, fixed income, and just general ecosystem of Canada to see what makes sense from a Canadian perspective. I think also, and related, the Bank of Canada announced a green bond program earlier this year in which they'll be issuing a $5 billion green bond in the next few months. There's been a lot of consultation with banks, with other governments, so provincials and municipalities, et cetera. On moment for the Bank of Canada and for Canada to really take a lead position in the sustainable debt market, specifically with this green bond. You know, to date in Canada, it's been mostly provinces, municipalities, financial institutions, and some insurance codes that have issued green bonds. But I think with the Bank of Canada stepping in and structuring one, I think it'll really catalyze the market. Earlier this year as well, we saw the government establish a net zero advisory body, which is really, you know, bringing together a group of experts to advise the government on pathways to net zero by 2050. And part of this announcement around the net zero advisory body was to enhance our nationally determined contribution, our NDC, under the Paris Agreement to 45% reduction in GHG emissions by 2030. And part of this as well is around a transition strategy to raise the federal carbon tax up to $170 a ton by 2030. So that was announced by the government earlier this year as well. I mean, all of this relates to transition. And Peter, you alluded to this. We're in a unique place in Canada where we're a very resource intensive economy. We have to acknowledge that we have a large resource footprint related to oil and gas, to mining and metals, to agriculture, to a number of different heavy sectors like carbon and aluminum and steel and others. And so I think the government is trying to understand the implications of positioning our businesses and our economy for a decarbonized future, but doing it in a way that makes sense with just the nature of our economy and what we'll need to see to remain competitive, but also to reduce our emissions, which are frankly high at this point. Last point I would make on this slide, the Ontario Capital Markets Modernization Task Force, they put out a series of recommendations earlier this year around disclosure, and that's been a theme that I've heard this morning, just enhancing disclosure generally. And interestingly, the Canadian government earlier this year tied some, and last year as well, tied some COVID relief financing to companies, especially large companies, aligning with TCFD in terms of disclosure. So if a company wanted to access some of the COVID relief, they had to commit to aligning with TCFD disclosures in future, particularly for companies over 300 million in annual revenue. And I think this was a good signaling from the government that investors want this information, but the government, and to Kim's point, the financial players, the lenders as well, the banks, also need this information to make informed lending decisions. And on the investment side, obviously investment decisions. You can go to the next slide, please. So just a few more regulatory developments. OSFI, our Office of Superintendent of Financial Institutions, has established a set of climate change scenarios that can be used for climate stress testing. So this is as amongst the major banks in Canada to do scenario analysis as per TCFD, but just generally to do some climate stress testing, just to see what the major levers that we're facing as a financial system are as it relates to climate change. We're also developing a national carbon offset market where, regulated facilities who need to exceed their emission limits or lower their emission limits rather, can purchase federal offset credits from, activities from Canadian farmers or foresters or indigenous communities or munis or other project developers who have created projects that, that establish these offsets that are then certified and regulated by the federal government. And then finally, the expert panel on sustainable finance. This is now going back to 2019. They published a report with a number of recommendations aimed at, expanding our green fixed income market. I mentioned the Bank of Canada Green Bond Program earlier, as well as promoting sustainable investment as frankly, business as usual within our asset management community. Finally, the chair of that expert panel, Tiff Macklem, is now the governor of the Bank of Canada. So you can see how sustainable finance and some of those recommendations specifically are going to start we're going to start seeing them more and more in policy coming from the Bank of Canada and the government at large. And finally, the transition finance taxonomy. So one of the recommendations coming out of that expert panel was to establish a working group to create a transition taxonomy. So this would be for labeled transition products that align with a pathway that decarbonizes, ideally in line with, Paris, a 1.5 degree scenario or a net zero scenario, particularly for our, certain heavy industries like, and I mentioned a few earlier, but oil and gas, mining, agriculture, forestry, and a few others that we have in Canada. And it's going to be a made in Canada solution, which says be brown, industries, or maybe brown companies within not so green industries, but we want to transition to lower emissions in the future. And this is part of that is once we establish this pathway and the set of activities that will qualify, we think it'll create a new opportunity for Canadian companies to access the transition market. Okay, next slide, please. All right, just very quickly on the Canadian sustainable debt market, I just wanted to touch on this because just to give everyone a sense of, where Canada's at as it relates to sustainable debt. Globally, sustainable debt, there's been $3 trillion worth of green social sustainability bonds principally issued since 2007. And in Canada, we're at 73 billion since our first green bond in 2014. Historically, green bonds have been the lion's share of labeled bonds issued. They're still the majority. In 2021 in Canada, we saw 49% of sustainable bonds were actually green bonds. But as you're seeing in the bottom left-hand chart, the overall proportion of green vis-a-vis other forms of sustainable debt is starting to get a little bit lower. And in particularly, we're seeing, social and sustainability bonds, sustainability bond being both green and social projects finance. and increasingly sustainability-linked products, which I know came up in Phil's presentation earlier and has come up in a few different forms today, where you have a product where it's a general corporate purposes type facility, unlike a green bond, which is green projects. A borrower or an issuer can use the proceeds how they wish, but the key here is that the coupon that they pay on the bond side could actually be changed, often increased, if they don't achieve certain predetermined KPIs. And we're starting to see, we've seen 2 sustainability linked bonds in Canada, Enbridge and TELUS, but we've seen a number of sustainability linked loans to the tune of almost 7 billion this year, with a variety of companies in different sectors. And so I think we'll start seeing more of these sustainability linked products into 2022. The key with all of this will be defining the parameters of what constitutes, solid KPIs. To Kim's point, the review and verification will be hugely important on the back end to determine whether or not the issuer actually achieved their KPIs, and whether, and to the extent there's a degree of transparency into, what the performance was, so that investors or lenders on the loan side can be sure that, the company did or did not achieve its predetermined KPIs. And then to the last slide, please. Just wanted to touch on, just for a moment, some of the investor sentiment that we're seeing in Canada, and some certain trends particularly. And an RIA, Responsible Investment Association, published a report saying that we had $2 trillion of responsible investment at the end of 2017, and that has since grown to 3.2 trillion by the end of 2019, and this year now it's up to almost 5 trillion. So we saw a 48% increase in those 2 years, and in the last year and a half alone, we've seen another 20% increase. It now accounts for almost 70% of Canadian AUM. Now, the definition of responsible investing is very broad, right? It's everything from negative or exclusionary investing all the way through to impact, with several sort of iterations in between. But importantly, I think for Canada, ESG integration and shareholder engagement are the 2 most common responsible investing strategies we see. And I think shareholder engagement is the one that really will move the needle, because that's where a company is not putting their head in the sand and saying we're divesting entirely from certain sectors. It's actually working with those companies, maintaining a seat at the table to say, you need to be better in future. You need to improve not just environmental performance, but social and governance as well. As a key shareholder of yours, we're demanding that this is the case, and we're seeing that more and more with different proxy voting initiatives across Canada. So I think that'll be one to keep an eye on in terms of increased engagement, both this year and into the future. Also want to highlight that Canadian universities have signed on to an investment to address climate change charter, which essentially has the 15 biggest Canadian universities engaging with companies. Again, the shareholder engagement I was mentioning to really improve their investment portfolios related to carbon emissions, so improve the emissions profile of the companies in which they invest. We've also seen asset managers with over 4 trillion in assets in Canada sign the Canadian Investor Statement on diversity and inclusion. So there's been some social and governance themes that I've heard today in today's meetings. Certainly, working with companies to adopt different targets, timelines and policies. Finally, we do, jointly call for better ESG disclosures as amongst their portfolio companies. So I think that's something to keep an eye on. And then lastly, not on this page, but just this morning, there was an announcement related to Climate Engagement Canada, which is a new program that involves 27 investors within Canada that collectively manage 3 trillion in assets. And it's similar structure to the Climate Action 100 Plus, which some of you may be familiar with, the 100 highest carbon emitting companies in the world. This one is a Canadianized version of Climate Action 100 Plus, and it's identifying the 100 highest Canadian emitters from a carbon intensity and carbon emission perspective. And these investors pledging to work and engage directly with these companies to improve, i.e. to lower their carbon emissions. So just announced this morning, but I think there'll be more to come. Maybe with that, Peter, I will pause and just see if there are any questions.
absolutely great, John. That's really useful to get that insight into what's happening in Canada. I've just got one which we'll try and slip in because we're coming near to the end, and that was it actually reflects back to something we were talking about earlier, and that is whether there are any, if you like, pockets of resistance within Canada. I mean, you mentioned you'd had the recent election, and the electorate was given on that occasion, you know, sort of broad support from whatever direction they went for this kind of agenda, but the question is whether or not we should be looking out for any pockets of let's say resilience for a carbon economy left in Canada, or do you think that everybody's on board now?
It's far from everyone's on board. It's much closer to there are certainly still pockets of resistance. I was heartened, you know, I gave the statistics that it was the first election where at least every of the three major parties all had climate related platforms. It was one of the 2 or 3 most important election issues, along with affordable housing and COVID recovery, I would say were the 3 most important issues. So there's an acknowledgement that it's critical, that we can't get this wrong, that we need to position Canada well and Canadian companies. But that's not to say it's unanimous in terms of acceptance. So if we look at, you know, some of the Western provinces like Alberta, Saskatchewan, and even in the East Coast, Newfoundland, these are very oil intensive and gas intensive economies. And so it's hard to think, you know, what happens if those entire sectors go away? What is the impact on the communities? What is the impact on the workers within those provinces? We're talking 40 or 50% of GDP in Alberta specifically. And so the question then becomes, how can we ensure those that say, look, like I even believe in climate change, but I can't put my family's health at risk. I can't be out of a job. That impacts my well-being. For those people, I think the key is going to be around skills and training development. And so I think we need leaders from government, even from the private sector to a degree, to help these different individuals get skilled up and trained so that, you know, as the economy is transitioning, because market forces are dictating that it has to, that they are not found out of work, that they are able to then transition to a new place of employment where they have the skills to excel in those jobs, et cetera. But until that skills training and that regime has been established, and it hasn't yet, there's still going to be resistance, because at the end of the day, people don't like the thought of being out of work, and I don't blame them. And I think we need to be really thoughtful, not just focusing on, you know, carbon emissions from oil companies as an example, but looking at the broader picture to say, what's the social impact as well of decarbonizing, of transitioning, and how do we make sure that no one's left behind?
That's really good response. I think that's actually got much wider resonance as well across other circumstances as well. If we look at any of the difficult to change areas, then we need to look at the human endeavor behind it and how actually we look after the people who are currently relying on their livelihoods made on something we want to change. So that's really good. Look, thank you very much, John. I want to make sure we do finish on time. We only have a couple of minutes, so I will move to wrapping up now. I do offer my thanks on behalf of everyone. You never get audible applause, unfortunately, on these things, but imagine that, please, all the presenters, both this morning and this afternoon. I think it's been, for me, tremendously successful in giving us the opportunity as TC322 and our close affiliates a chance to get into some really interesting topics at a level of detail that I know we won't be able to in our plenary. I look forward to seeing pretty well all of you, I think, at the plenary in 1 week's time, and look out for the information coming forward on that.